The 2017 edition of our Dynamics of Small and Medium Business report is out, and we discuss the highlights. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. The latest edition of the Digital Finance Analytics Small and Medium Business Report, which is available for free on request, reveals that more than half of small business owners are not getting the financial assistance they need from lenders in Australia to grow their businesses. Here are the key takeaways. Overall lending to the sector stands at about $260 billion. Around half of which is secured against residential property. Overall write-downs from the sector are running at around $5 billion each year and have been relatively stable over the last couple of years. More than 3% of unsecured loans are written off, and they comprise more than half of all write-downs. Most SMEs are now digitally literate, yet the range of products and services offered to them via online channels remains below their expectations. More SMEs are willing to embrace non-traditional lenders via fintech, thanks to greater penetration of digital devices and more familiarity with these new players. In addition, many firms said that they would consider switching banks, but in practice they do not. Overall business confidence has improved a bit compared with our previous report, but the amount of red tape which firms have to navigate is a considerable barrier to growth. Running a business is not easy. In some industries, more than half of newly formed businesses are likely to fail within 3 years. We found that banks are not offering the broader advice and assistance which could assist a newer business. So even simple concepts like cash flow management, overtrading, and debtor management are not necessarily well understood. There is a significant opportunity for players to step up to assist, and in so doing they could cement and strengthen existing relationships, as well as creating new ones. We think simple robo-advice could be offered as part of a set of business services. The sector is complex, and one size certainly does not fit all. There are around 2.2 million small and medium businesses operating in Australia, and nearly 5 million Australian households rely on income directly or indirectly from them. So a healthy SME sector is essential for the future growth of the country. By way of background, we define small and medium businesses, SMEs, as those trading with a turnover of up to 10 million, either employing or self-employed, and with an Australian business number. This definition therefore excludes individuals who are running micro-businesses informally, for example as part of the gig economy, or selling the odd item on eBay. We curate a rolling 52,000 firm survey each year, with around 4,000 new firms being added each month. The survey is a telephone omnibus and is executed on our behalf by a reputable service bureau. It is statistically accurate across the country. We design the questions and analyse the results using our core market model, which combines information from our surveys with other private data that we obtain from the market and also public data from government agencies. We hold information about their business structure, banking relationships, and financial profile, as well as their digital behaviour. This provides a multifactorial basis for our underlying segmentation, which has proved to be both stable and insightful over time. We believe strong segmentation is essential to be able to translate strategy into effective action. In this edition in particular, we focus on what we call the voice of the customer. The purpose is to show the rich diversity across the SME community. The custom segmentation we use is well distributed by count across the business community. Growing businesses and cash-strapped sole traders are the two largest groups. As expected, the large established firms have a small account. Some segments have a tendency to combine their personal and business finances and do not see their business finances as separate. Entities established as a company hold separate accounts more often. The largest industry segment is construction at 17%, followed by professional, scientific and technical at 12.5%, and then rental, hiring and real estate at 11.5%. Financial services at 9% and agribusiness at 8.25% are the next two. Note that the mining sector accounts for only 0.4% of all SMEs. 1/4 of SMEs have a sales turnover of less than $50,000 a year, and more than half have a turnover of less than $150,000 per annum. The majority of low turnover businesses are unincorporated. Those businesses with larger turnovers are more likely to be formed as a company. Looking at the state distribution, 60% of businesses are located in New South Wales and Victoria. The failure rates of businesses vary significantly by segment and over time. Using data from our core market model, we can profile this by individual SME. Cash-strapped sole traders are the most likely to fail, with 55% failing in 5 years, followed by cash-strapped sole traders and then stable subcontractors. Finally, we see variations across states, and the highest failure rates are found in South Australia, while the lowest failure rates are in the ACT. The propensity to borrow varies by segment significantly. Career-switching startups are least likely to borrow, followed by hobbyists. Businesses in transition and cash-strapped sole traders are the most likely to borrow. The main reason to borrow varies across the segments. Working capital remains the most significant driver for many, though. And if you go the next level down, for many segments, the main cause of the need for working capital relates to delayed payments. This is particularly a concern amongst some smaller businesses. Satisfaction with banking services remains in the doldrums, with around half of all businesses dissatisfied or very dissatisfied with their bank, and only 17% very satisfied. But when asked about their propensity to switch, 61% said they would consider moving. However, when we examined their length of time with existing banking relationships, it's clear that many are rusted on long term. The inertia and the gap between the intent to switch and actually switching is explained by a combination of time constraints, complexity of switching, and the lack of available alternatives. Again, this footprint varies by segment. The digital revolution has wrought significant changes in how SMEs manage their banking and interact with their service providers. Based on their digital footprint, we identify them as natives, already using digital and always have, migrants, using digital, having migrated to it, and Luddites, resisting the move towards digital but moving there slowly. Overall now, only 13% of SMEs fall into the Luddite category, 53% are migrants, and 34% are natives. So digital is now mainstream. We also measure relative business confidence across the various segments. The higher score, the greater the relative confidence of the business. We found that professional independents and large established firms and mature businesses are the most confident. They will have generally been trading for longer, will have established customer relationships, and will have mature business processes. At the other end of the spectrum, those starting out are less competent, perhaps rightly given the higher failure rates, difficulty in finding funding, and needing to seek a customer base. We see some variations across industries, with education and training, information, media and professional and technical the most positive. At the other end of the spectrum, mining was the least positive. And so to summarise, there is significant opportunity to tailor banking services to target groups within the SME universe. Many players still offer generic services which do not take into account the specific and diverse needs of the sector. And as a result, many businesses are rusted on to suboptimal long-term banking relationships. The leverage that both firmographic and digital segmentation can bring is the key to effective growth. Many fintechs are already well down this path compared with large incumbents, and we believe the sector remains ripe for innovation and disruption. I'm Martin North, Principal Analyst at Digital Finance Analytics. The 2017 report is available on request. If you found this useful, do subscribe to receive future updates, and thanks for watching.